To me, the market has three moods. You've got rally, reality, or recession. And I think what we're in right now is reality. Anybody who's about my age will understand the term reality bites. And here we are in a period where we've got to get used to the idea that controlling inflation causes collateral damage. And I think that's probably what Mike is getting at. There's collateral damage that will be happening in stock prices. There's collateral damage that'll happen to growth projections if we continue to hike rates and we continue to be nervous about inflation. And we've got this supply chain disruption that's going to have lingering effects even beyond a war that may or may not de-escalate. So when you look at your portfolio, yes, you do want to have an allocation to defensives in it, because if we're in that reality situation, you have to have stuff that's going to hold up when we have those little gyrations. I think a good level on the VIX now is 20, and we should be happy with 20. That's much more elevated than what we've been used to at other times. So you want to make sure that you have an allocation on both ends of the barbell of the risk spectrum. But I still wouldn't necessarily be waving the flag, getting out of the tech trade, getting out of cyclicals. I still think that there's some room to go this year. It's just not going to be smooth, and it's not going to be pain-free.
Okay, so Steve Weiss, if this, look, market's having a nice moment right now at noon. We said the Nasdaq's up 1.5%. I'm sure there are people convinced that it's not a bear market rally, that it's the start of something anew. But if it's not a bear market rally, how do you explain what's happening in the defensives? Why are utilities hitting new highs on Friday? Why is real estate coming off its third straight positive week? Why are staples coming off the third straight positive week? Why is healthcare coming off a positive month? Why are the mega caps the ones that are leading again? Isn't that a signal of something?
I think it is. And, you know, I've been looking for the mega caps to, which is why I haven't reduced those positions, to be where money goes to hide and where money looks for performance because their franchises, their businesses are so strong. Look at the move in Facebook, which I bought last week for a trade and still in. So I do think that's where money's going to go, and I do think it is a tell. Now, when you take a look at what happened today, Goldman Sachs downgraded Baxter, and you would think, okay, well, it's got something to do with the fundamentals of their business. Well, it does actually. The fundamentals that are raw material, resins, price increases, plastics, price increases that are going to impact margins. So this is an analyst that's getting in front of it. I think that's going to be the story through earnings, that margins are coming down. Forecasts for earnings growth are going to be lower, and that's what's going to prey in the market. So this is a moment in time. Can't tell you that I'm surprised by the rally in this market. I am. I'm surprised the VIX has stayed down relatively, measured levels and hasn't spiked. But I think it's just a delayed reaction. So I'm still staying at about 45% net long equities, and I'll buy opportunistically as I have.